They say the next global recession isn't a matter of if, but when. The headlines hint at it, the markets tremble around it, and central banks? They're walking on a tightrope over a pit of economic uncertainty. But here's the real question. How close are we really to the next global meltdown? Not in theory, not in fear, but in facts. Because behind every news cycle and market rally, there are signs, patterns, and cracks forming in the foundation of the global economy. And in the next few minutes, we're going to walk you through the economic truth that many aren't ready to confront. This is about what's already happening and what it means for your money, your job, and your future. To understand where we're heading, we need to grasp what a global recession truly means. It's not just a slowdown in one or two countries. It's when the majority of the world's largest economies start to contract, trade volumes decline, and unemployment surges across continents. The last major global recession struck during COVID-19 in 2020, but that was caused by an extraordinary health crisis. Before that, the 2008 financial collapse rewrote the rules of modern finance. Today, in 2025, we face a different kind of threatless, obvious, more systemic, and far more complex. There's no single smoking gun. Instead, there's a collection of troubling signals flashing red all at once. One of the most telling signs is the inverted yield curve in the U.S. Treasury market. Historically, every time long-term interest rates fall below short-term ones, a recession follows, and it's happened again, not just briefly, but persistently. At the same time, GDP growth in major economies like the US, China, Germany, and the UK is either slowing sharply or entering negative territory. Layoffs are ticking upward, particularly in tech and manufacturing. And while unemployment rates remain officially low in some regions, underemployment and job insecurity are rising, especially among younger workers. Corporate profits are shrinking. Businesses are scaling back. Households are tightening spending. Central banks around the world, especially the Federal Reserve, are stuck. After aggressively raising interest rates to tame inflation, they've now reached a crossroads. If they cut rates too early, inflation could roar back. If they hold rates too high, borrowing slows, investment halts, and the economy grinds to a halt. It's a trap. And this kind of monetary paralysis is exactly what precedes deep recessions. We're seeing rising credit defaults, declining small business lending, and stagnating housing markets. Real estate prices are cooling, not just in America, but globally. Meanwhile, China, the engine of global growth for 2 decades, is sputtering. The property sector is in crisis, with major developers collapsing and housing values falling sharply. Chinese consumers are saving, not spending. Youth unemployment is alarmingly high, and for the first time in decades, China's population is shrinking, creating long-term demographic headwinds that no stimulus can fix. Add to that weak export demand from the West, and suddenly China's miracle economy looks more like a mirage. If China slows, the ripple effects hit every corner of the globe, from African commodity exporters to American tech companies. Europe isn't faring any better. The ongoing war in Ukraine has sent energy prices soaring and disrupted trade across the continent. Germany, once the EU's industrial powerhouse, is now in a technical recession. Manufacturing is down. Consumer sentiment is fragile. France and Italy are facing fiscal pressures that could boil over into sovereign debt risks. And let's not forget, the European Central Bank is in the same bind as the Fed, trying to fight inflation without crushing the economy. All of this is happening in the most interconnected economic zone on Earth. A spark in one country could ignite a continent-wide downturn. The U.S. consumer, the supposed savior of the global economy, is also weakening. Credit card debt has crossed $1.3 trillion, with average interest rates hovering above 20%. Student loan repayments have resumed. Savings from the pandemic stimulus era are long gone. Inflation-adjusted wages are barely moving. Americans are working more just to stand still. If they cut back spending, which they're beginning to do, it will be felt worldwide. Consumer demand powers everything from Apple to Amazon, Nike to Netflix. When that demand dries up, global earnings sink. Let's zoom out even further. Global trade is no longer what it used to be. Supply chains are being rewired. Countries are increasingly turning inward, relocating manufacturing closer to home in response to geopolitical risk. This deglobalization trend adds friction, raises costs, and weakens efficiency. Shipping lanes are also under threat, whether it's Red Sea attacks or climate disruptions like droughts that shut down the Panama Canal. Higher shipping costs mean higher prices, more pressure on inflation. The old model of fast, cheap, global trade is dying, and no one really knows what replaces it. There's also the slow but steady erosion of the dollar's dominance. BRICS nations, Brazil, Russia, India, China, and South Africa are pushing for a new global currency framework. While a full dollarization isn't imminent, the intent is real. Central banks around the world are increasing their gold reserves, hedging against potential currency volatility. U.S. debt levels are astronomical, and global trust in American fiscal discipline is eroding. If the dollar weakens significantly, international trade, oil prices, and financial flows could be thrown into chaos. This uncertainty alone is enough to spook global investors. And now, we must ask, what could be the spark? What's the event that turns all this tension into collapse? It could be a major bank failure in Europe or Asia, something that shakes confidence the way Lehman Brothers did in 2008. It could be an oil shock triggered by a broader conflict in the Middle East. It could be a sovereign debt default by a heavily leveraged country, Italy, Japan, or even China's shadow banking sector. Or it could be a tech bubble burst if AI stocks or crypto assets crash hard, erasing trillions in wealth overnight. Each of these risks alone is concerning, but together, they create a perfect storm scenario. So what should you do? You can't control the global economy, but you can control your exposure. Diversify your investments. Don't keep all your money in a single market or asset class. Build an emergency fund that covers 6 months of expenses. Avoid high-interest debt, especially credit cards and personal loans. Invest in your skills and income streams. Whether it's learning a high-income skill, starting a side hustle, or understanding financial markets, you need to be proactive, because recessions don't wait for you to be ready. They hit fast, and the unprepared suffer the most. The truth is, we're closer to the next global recession than most people think. Maybe not next month, maybe not this quarter, but the momentum is shifting, and the cracks are widening. Governments, markets, and individuals alike are feeling the weight of what's coming. It's not fear-mongering, it's data, patterns, and logic. If you're not paying attention now, you'll pay for it later. So, stay alert, stay informed, and stay one step ahead. And if this video gave you insight that you didn't get anywhere else, hit that like button and subscribe to MacroMotive, where we decode the economy so you can take control of your future.